The more contacts between prices and trend line, the more valid that line. When the trend is up, a return to the trend line shows a rebellion among bears. When the trend is down, a rally to the trend line shows a rebellion by the bulls. When prices pull back to a trend line and then bounce away from it, you know that the dominant market group has beaten the rebels. A preliminary trend line is drawn across only 2 points. 3 points of contact make that line more valid.
4 or 5 points of contact show that the dominant market crowd is firmly in control.
The angle between a trend line and the horizontal axis reflects the emotional intensity of the dominant market crowd. A steep trend line shows that the dominant crowd is moving rapidly. A relatively flat trend line shows that the dominant crowd is moving slowly. A shallow trend line is likely to last longer, like a turtle racing against a hare. It pays to measure the angle of every trend line and write it down on your chart. This can be done using a computer, a protractor, or a Chinese charting tool. Comparing angles of trend lines shows whether the dominant market crowd is becoming more bullish or bearish. It is uncanny how often trend lines trace the same angle time and again in a given market. It may be because the key players seldom change. Sometimes prices accelerate away from their trend line. Then you can draw a new, steeper trend line. It shows that a trend is speeding up, becoming unsustainable. When you draw a new, steeper trend line, tighten your stop, place it immediately below the latest trend line, and adjust that stop at every new bar. The breaking of a steep trend line is usually followed by a sharp reversal. When the trend is up, volume normally expands when prices rally and shrinks when they decline. This shows that rallies attract traders while declines leave them cold. The opposite occurs in downtrends. Volume expands on declines and shrinks on rallies. A pullback on heavy volume threatens a trend line because it shows that the rebellious crowd is growing. If volume expands when prices move in the direction of a trend line, it confirms that trend line. If volume shrinks when prices pull back to a trend line, it also confirms the trend line. If volume expands when prices return to a trend line, it warns of a potential break. If volume shrinks when prices pull away from a trend line, it warns that the trend line is in danger. The breaking of a well-established trend line shows that the dominant market crowd has lost its power. You have to be careful not to anticipate trading signals. Most traders lose money when they jump the gun. A trend line is not a glass floor under the market. One crack and it is gone. It is more like a fence that bulls or bears can lean on. They can even violate it a bit without toppling it, the way animals shake a fence. A trend line break is valid only if prices close on the other side of a trend line. Some traders insist that a trend line has to be penetrated by 2 or 3 percentage points of price. After a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old uptrend line from below. When that happens, you have a near-perfect shorting opportunity. A combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. The reverse also applies to downtrends.